for, I guess, listening in and indulging us on our pet conversations. And so it's certainly better than talking about the remaining 4 states that we're waiting to hear get counted. And so I'm Leonardo McClarty, the president of the Chamber, and like to welcome you all to what we call Ask the Experts. And this is in essence, our small business seminar series where we talk about a number of issues that would be of interest, I should say, to small businesses. And so today, we're going to be talking about various tax breaks and credits and things that have come about as a result of COVID, and that as a small business owner or maybe consultant that you'd want to be aware of, perhaps take advantage of, share with clients, et cetera. And so we have with us Cheryl Finkelstein, who is a CPA with DEMBO Jones, who is going to be sharing insights with us momentarily. And so, but because, actually, before we do that, I want to just bring to your attention a few things that are upcoming that I think would be of interest, particularly to this group. And so the first is our upcoming executive speaker series, which is a salute to veterans, which is going to be on November 10th. And so that is, we're going to have with us the new garrison from Fort Meade and Colonel Christopher Nyland. And he's going to be sharing with us leading in uncertain times. And so I think, he is, when you read his background, he has served in a number of places that are not always so friendly. And so with that, he has been able to work with a number of leaders, particularly military-wise. And so we'll be sharing some of his experiences and things that he's picked up along the way when it comes to leadership and dealing with unexpected circumstances and so forth. Also, November 18th is our annual economic forecast with Anirban Basu. And so that is always going to be a hit. So that's November 18th. The other thing I want to mention on the not breakfast, but the lunch next week on the 10th, if you are a veteran, it is no charge to attend. Just simply use the promo code veteran. So again, that's next week. Let's see, I'm going to stop the share here. And then also want to just recognize and acknowledge our annual partners who you see reflected on the virtual background behind me. And again, they have supported the Chamber throughout the course of this year. And certainly are appreciative of their support. And so before we have Cheryl present, we've got a small enough audience that I thought it would be good for us to just go around and introduce ourselves to each other, particularly state the business that you're in, and maybe if there's something that you want to gain today. I think that will certainly continue to help Cheryl as she goes through. So to help everyone out, I'll just call you out just so I can see you, and it makes it easier not having to figure out who goes first and second. And so first we'll actually have Lisa Anderson.
Oh, good morning, everybody. I'm Lisa Anderson. My company is Anavo Transformation Solutions, and we help companies in and around the federal government contracting community, professional services companies. We help them scale and grow profitably and lead their way to legacy. We do this through strategic advisory, virtual CFO solutions, and federal government compliance support. And I'm also a member of the board of directors here at the Chamber.
Thank you. And Lisa chairs our women's conference committee as well.
I always forget that.
And so next I'm going to ask, and I can't see the name, it's just on the screen, it says F22Z. It's again, F22Z. I'm also asking you to unmute to give you an opportunity so maybe I'll come back to you. So I don't know who's coming up as F22Z on the screen, but maybe next we'll go to Lindsay Moore.
Okay, hi there.
Hello there.
Hi, okay, just wanted to make sure you could hear me.
Yes.
There's my video too. Okay. My name is Lindsay Moore. I am with Moore HR Solutions is my company. I also work with HR Strategy Group. So I am an HR consultant, work with a lot of small businesses, helping them with their HR function, and just really interested today to hear, more about things that we can do, regarding the tax breaks and everything happening with COVID. So happy to be here.
Excellent. And thank you, Lindsay. And so I'm going to try to come back to this other person here just to make sure, again, whoever is F22Z, if you can see your screen, maybe that would help you know that your name is not showing up. But perhaps next we'll go to Main Street Rugs. And you're muted still.
Can you hear me?
There you go. Yep.
Excellent. Thank you for organizing this. I appreciate it very much. This is Main Street Oriental Rugs. We are at 8290 Main Street in historic Ellicott City. After facing 2 floods and now COVID-19, we're looking forward to the new challenge. I hope that COVID-19 doesn't have a brother or a sister, bigger brother or sister who comes with it. So let's hope we will move forward to better things. And looking forward to hearing new ideas and what we can do to move forward. Thank you.
Excellent. Thank you. And thank you for joining us. And next is Michelle Puya.
Hello, can you hear me?
Yep, we can hear you.
Sorry, I've been having some technical difficulties, so I'll start with that. So I have a business brokerage firm, and we help small businesses. So we've been hand in hand with all the businesses throughout COVID. Have felt the pain with the small businesses, with you guys as we muddle through this and feel our way through. But I must say that it's been comforting and a lot easier to get resources and develop plans for some of my clients through the chamber to, feel comfortable that I'm giving them the right information. So very appreciative of that.
Excellent. Thank you. And so I'm going to see if 3 is a charm. I'm going to go back here again to F22Z. Just want to make sure I'm not leaving anyone out. And so with that, I want to introduce members of the chamber team. And so we have Taylor Tarleton, who many of you know is our events manager and is often the puppet master behind the scenes, pulling the strings on whether it's Zoom or WebEx or what have you in terms of making sure that things go off well. Also, we have Lynn Saul, as well, who's our director of operations. She's on, and Lynn is often communicating with our sponsors and assisting me in board communications, and again, making sure the chamber office in and of itself is managed and runs appropriately, and dealing with vendors and that whole nine. And then our newest member, in Morgan Simonet, who is our director of membership and external affairs. And so glad to have Morgan on, continuing to check things out and seeing what we do. This is our first week. And so, so she's now 4 days in, and glad to have her. And so lastly, but certainly not least, I'm going to introduce our speaker today. And that is Cheryl Finkelstein. And she is a director with DEMBO Jones. And just a little bit about Cheryl's background. She's undergraduate degree from University of Maryland, College Park. She focuses on small businesses, high net worth individuals, not-for-profit organizations, operating and non-operating private foundations. And so she has over 20 years of experience in public accounting involving tax return prep and review and accounting services for small businesses, again, sole proprietors, high net worth individuals, not-for-profit organizations, and again, operating and non-operating private foundations. She reviews and prepares complex tax returns, as well as, again, for business returns, and has also served as an expert witness in also those unfortunate situations like divorce cases. She is also very active with her synagogue, and also teaches continuing ed to accountants on individual and business tax prep and the latest tax developments. So as she shared with me earlier, truly she is someone that she loves tax. And so I think we've got a great person here to talk about, again, some of the changes that have been made as a result of COVID and what you might expect. So with that, I am going to turn things over to Cheryl. She's going to share her screen and we'll get started.
Thank you for everybody for coming. And let's see if my screen will share. It is. This one. Can everybody see my screen now? Am I muted?
Nope, you're good. We can hear you. I mean, we can see you and hear you.
Can everybody see the screen?
Yep. Yes. And and so Cheryl, just really quickly, I'm going to just the mysterious F22Z was Alexander Brown from State Farm.
Oh, okay.
And so Alexander Brown is very active with the chamber and also sponsors our ribbon cuttings as well. So thanks, Alexander, or Alex, really, because you don't go by Alexander.
Okay, so
all right.
I'm just making notes. So I am a tax geek. I truly love what I do, and I get very passionate about taxes. Not a subject a lot of people get passionate about, but I am one of those rare people that will get passionate as I'm teaching it and as I'm preparing returns and trying to give advice to my clients. So with COVID, there's been a lot of changes. Back in 2017, Congress made a lot of changes to everybody, to the tax code. And basically, a lot of those changes were undone, which is very tax beneficial to the small businesses this year. So a lot of the changes, as we go through them for the tax law changes, are going to pertain really to carrying losses back, not forward. Things that we can do from prior year settings. Why is my mouse not working now? Rather than going forward. So my mouse and I are arguing, I apologize. So one of the things that came in was the CARES Act, and it had business provisions within it. So they brought in the employee retention credit, the delaying of payment of payroll taxes, modification of the net operating loss rules, and this is huge. This is a really big benefit for taxpayers. Modification of the loss limitations, which they brought in 2018, which essentially were undone by the CARES Act provisions. And then they updated the definition of qualified improvement property, not something a lot of people think of, but for accountants and for businesses that are building out, it's a huge provision. It makes a big difference. So we're going to go through some of them. If you have questions, please feel free to ask, or we can do them at the end, whatever will work best for you. So the employee retention credit, I'm sure everybody's heard of the PPP loans. Lots of people signed up for them. If you have a PPP loan, this is one credit you cannot take. But it's applied against the Social Security taxes that the employer pays. So the 6.2% of taxes that you're paying on your employee's payroll, up to $10,000 worth of payroll per employee, that can be, you can get a credit for that. And it's for the wages paid between March 12th, 2020 and January 2021. So if you think about it, it can have $620 savings per employee. It's a good credit. It's if you don't have a PPP loan. It's a great idea. So it's just something to think about. Not everybody files for PPP loans. A lot of people, some people I know didn't want them. They didn't like the idea of a loan, even though there was pretty good chance of forgiveness of the debt. They didn't want to take a loan. So this is something you want to look at and make sure you're taking advantage of if it applies to you. This one, the delaying of payment of payroll taxes. So basically, you pay your employees, but you don't have to make those payments The Social Security and Medicare taxes are paid out. They're stretched out until 2022. So you have to make half of the deposits by December 31st, 2021, the remainder by December 2022. And it's just a nice deferral, and this also applies to self-employed individuals. And they clearly stated that a lot of times a self-employed sole proprietor gets left out of these or feels that they do not benefit from a lot of these business provisions, but this will apply to the individual as well. So it's a nice provision. If I'm speaking too quickly, someone please just send me a note or flag me. I am from New York. I've been down here 30 years, but I still speak like a New Yorker. So I will apologize if I'm going too quickly. This, the modification of the net operating loss rules, this is one of my favorite provisions because we know in 2019, business was okay for a lot of the clients, but in 2020, we're not expecting a good tax year. We're just not. A lot of businesses haven't been operating at full capacity. They haven't been able to open. So if they're paying their employees, a lot of them are operating at a loss. So back in 2017, they eliminated the opportunity to carry those losses back to recoup taxes paid in prior years. What the CARES Act did is now allows you to carry those losses back. So you can carry them back for 5 years. So if you have a loss coming up in 2020 and you paid tax, you had a business income in 2017, 18, 19, you can take that loss back and recoup some of those taxes, which is great. That's a huge provision. So it's a big benefit to individuals and small businesses. The state of Maryland is allowing it. They do have a modification for it, and we'll go over that. But this is a great provision for people. So if you've had a loss this year in 19, if you're thinking you're going to have one in 2020, what I'm planning on doing for a lot of my clients that always like to file late in September, they like to push it right to the tax deadline. I'm advising them to file early so we can prepare the net operating loss carrybacks and get them some refunds, get them some cash. Just something to think about. Think about how your own businesses are doing and talk to your accountants or your advisors and say, is this something I should be thinking about? Should I be thinking of taking some losses and carrying them back? If you don't have any losses to carry back, you still are allowed to carry them forward, which is nice too. So those will be available for future years. But if you're trying to recoup money from prior years, this is a great way of doing it. So in 2018, the first year they came in, Congress, as part of the TJCA, the 2017 Tax Act, decided to limit losses. So if you were a single individual and you had losses of greater than $250,000, yes, you had a really bad year. Married filing joint, you're allowed to take up to 500,000 of them. You were limited. That was the max. You can take 250,000, 500,000. Some clients, especially in real estate, I've noticed in prior years in 18 had really bad years. So all of a sudden we have this opportunity to go back and amend our 2018 returns if you had a loss that was limited based on these rules. So it's something that's great for 19 and 20, and you can carry it back, and you can actually go back and amend your 18 return to pick up any of these losses. Hopefully nobody suffered losses in those amounts, but it's just something to think about because it was a nice provision that they put in there. There we go. So qualified improvement property, for accountants, this was a huge change because it was originally written in the 2017 Tax Act. And so they're changing the definition of it. It was supposed to be a 15-year depreciable life, but they didn't put it in the final version. So if I owned a business and I put in leasehold improvements, if I put up new office walls, if I had to build out my space, if I did anything along those lines, if I put in new flooring, if I had to do an expansion, I had to depreciate those assets over 39 years. What the CARES Act did is they changed it back to 15 years and they made it retroactive to 2018. So if you've done some major leasehold improvements to your business or your property, this is an opportunity to carry them back, to carry the losses back. This is an opportunity to amend your 18 return to change the life of the asset from 39 years to 15, and you can expense it using Section 179. So again, this is something you may want to talk to your tax advisor about, but if you did some build outs, this is something that really will apply to you. I don't know if anybody has questions, but we'll go for it. And this is something some people, whoop, go back. Hold on, I went back forward instead of backwards. This is something, I don't know everybody's basis of accounting, but you may want to consider looking at the rules and seeing if you qualify from changing from an accrual basis of accounting to a cash basis of accounting. This came in again with the CARES Act. So up to if you have gross receipts of up to $25 million and you've been on an accrual basis account, you've been paying taxes on an accrual basis. So essentially you've invoiced your client for something. So they may have they may have ordered supplies, they may have given you an invoice for something and you've recorded the accounts receivable. You've picked that up as income already, but you haven't actually received the cash. It's just an outstanding balance on your books that's owed to you, but under the accrual basis of accounting, you're paying taxes on it. So now the CARES Act gives us the opportunity to switch it to a cash basis and pay taxes on it when you actually receive the income rather than when you just record the income on the books. But you do want to look at this. The other side of the coin is when you're an accrual basis taxpayer, you get to expense things. So if you run up, if you go out and buy things or you order a lot of supplies on December 31st, you've recorded those expenses. You're allowed to, under accrual basis of accounting, deduct those expenses, even though they haven't been paid for, if you've just made the order, signed the purchase order. That ability goes away when you switch to a cash basis. You have to have paid the outstanding debt in order to take the deduction. But it's still something to think about. A lot of people realize huge savings by switching to a cash basis if they've had a large accounts receivable balance. Especially going forward, if your clients are being slow to pay, you've billed the clients, but you haven't received the income yet. This is a great opportunity to look at and say, would I be better off if I switched my method of accounting and changed it to a cash basis? So the next thing I want people to think about is, in most industries, meals and entertainment. We take people out for meals, we entertain them. It's how we develop business. It's a lot of people like, oh no, Cheryl, that's not a meal, that's an entertainment. That's a business development expense. Unfortunately, the Internal Revenue Code and our definition of business development differ. So back in 2018, 2017, effective 18, when they changed the tax law, they changed the definition of meals and entertainment and which expenses are deductible and which expenses aren't. So as you're recording everything, as you're going out and charging things on your credit card for meals, make sure you're taking the time to classify them correctly, think about what they were for, so you can get the most bang for your buck. You don't want to just assume all meals and meals are 50%. Some of them are not. So you want to really think about what you're doing with your meals expenses. One of the things, I have clients that, Cheryl, well, I have box seats at the Ravens game. I'm like, that's great, not deductible. And all of a sudden my clients are like, I had a loss on my tax return. I'm like, yes, and we discussed box seats, Ravens tickets, Washington Redskins tickets, Orioles tickets, national tickets, not deductible. It's just not the way it is. However, if you're at one of those games and you buy your, and it's separately, you buy your contact a meal, that portion, the 50%, you can still take that portion of it. So it's very important when if you're taking someone to one of these games, think about it. Okay, I can't take the ticket, but don't lump it all under tickets. If you've paid a separate portion of it and it's separately stated on your bill, you know, you go to the hot dog stand, you get a bunch of beers, whatever you're doing there. I know they have lots of great food there. Whatever you're doing, that food is still deductible. The Ravens tickets, the box seats, not going to happen, but the meal portion. So really think about it as you're taking people out. Employer provided meals are deductible at 50%. So when you have employees in the office and you're paying for their meals, it's deductible business expense at 50%. Employee meals while traveling are deductible at 50%. So you really want to make sure you understand what they're doing. Now this one seems counterintuitive, but I like it, that the expenses for recreational, social, or similar activities for the benefit employees is 100% deductible. So think about what you're doing for them. Are you having a holiday party? Are you doing an outing? Those are 100% deductible. So when you're doing your annual holiday party, if you're going to do one this year, if you've done one, if you've done a gathering, like we do a summer outing at our firm. Unfortunately, this year we couldn't do it because of COVID restrictions. But if you've done a summer outing and you're planning one for maybe next year, or you're hoping you'll be able to host a small holiday gathering, think about that. Make sure you classify it as an employee business expense, as an employee perk for food and beverages for the general public. My tongue is getting tied, I apologize. Make sure that you're taking this one, the expenses for recreational, social, and similar activities for employee, AKA the holiday party, and coding it as the holiday party so you can get the full benefit of it. You don't want someone coming behind you and saying, oh, that was lumped under meals and entertainment, and only giving you a 50% deduction when you're entitled to a 100% deduction. So you really want to think about how you're coding those and recording them so people going behind you can make sure everything is treated correctly. And then if you have expenses for food, beverages, and entertainment that are available to the general public, like I have down here, snacks at a car dealership, those are 100% deductible. And I've been to a whole bunch of the car dealerships. They always have popcorn out, they have cookies out, they have coffee. The employees are eating them and the general public is eating them. So those type of expenses are 100% deductible. I don't know if we have questions I can't see. Before I go on to talking about some of the individual provisions, does anyone have questions on anything I've covered so far?
So I'm not seeing any questions down in the chat, but maybe while we're at a pause, well, just to ask if, you know, again, if there are any questions, certainly don't feel shy. We want this to be, you know, interactive and engaging. And so, again, if you have questions, don't hesitate to ask.
At least let me know you're still awake.
Well, I'm talking, so I'm still here.
Am I speaking too quickly? I'm a New Yorker, so that's what I said. I speak very quickly.
I think you're fine.
Okay. Okay. Am I still sharing or do I need to share?
Nope, you're good. And we just got a comment in the chat that at least that, you know, everyone is still there. So.
Yay. Hopefully I'm covering information that everybody's finding useful. We're giving them things to think about because everybody's tax situation is different. So you want to think about how this information can relate to your tax situation and things that you may want to take back and discuss with your tax advisor. So I'm going to go into some individual provisions as well, because I don't know if I have any sole proprietors out there, single member LLC people, who some of this will apply to. So some of the biggest individual provisions that came in, which will save us taxes this year, if you're of the retirement age and we're subject to required minimum distributions, we want to talk about that. The new above the line charitable contribution, this is new. Modification of charitable contributions for tax years after 2019, and then special rules for the use of retirement funds. And then after this, I have some very specific Maryland things I want to discuss, especially based on what Governor Hogan said at his last press conference, or the press conference that he had towards the end of October. So one of the things for special retirement, use of special retirement funds, because of COVID, we know people aren't working, income is down. There's a waiver of the early withdrawal penalty. So rather than have to pay the 10% penalty, which is standard if you take money out of your retirement accounts premature before the retirement age, you can get a 10% waiver on those. You don't have to pay the 10% penalty if your funds are used for someone diagnosed with COVID-19. Hopefully nobody has experienced it. It's very scary. Or for someone who experiences adverse financial consequences as a result of being quarantined, furloughed, or laid off, unable to work due to no child care, or closing and reducing of the business hours of business operated by them. So again, that's real. This one really will be for the sole proprietor who's not being able to work. If you have one of the industries I know that's being hit really hard is event planning. Event planners can't really plan events. There are limits throughout the state on the size of the gatherings, and nobody's really having, even now Montgomery County just is getting ready to roll their limit back to 25 people. Nobody is going to be having a big event. They're not going to be having the big, Christmas tree lighting and things like that at the mall. I don't see Columbia Mall doing the big Christmas tree lighting with the crowds gathering. Things like that are going to go away, which really affects event planners and the related industries, florists and things like that. So they're adversely affected by COVID, and they're probably closing or reducing their hours because of it. So just think of it along those lines. So if you need to take money out of your retirement account, if you meet one of these qualifications, you can do so without the 10% early withdrawal penalty. And then if you want, the funds can be repaid right evenly over 3 years. You do have the option to repay them all at once, but you can repay them over 3 years. So this is something just to think about. A lot of people didn't realize about this one, that, oh, I'm in bad financial straits, I can't make my mortgage, but I do have this money set aside in my retirement plan. Yes, you can take the money out. It's not my favorite idea, but I'd rather do that than lose the house, get evicted, things like that. So it's just something to think about. So for 2020, if you are of retirement age and you're in a good situation, you don't have to take your RMD. So rather than take that $15,000, $20,000 distribution, if you don't need it, some people it's $75,000, depending on what that distribution is, you're not required to take it this year, which is great because, well, maybe you don't want to have to pay the taxes on it. If you take that distribution, you have to pay the taxes. If you don't take that RMD, you're not required to pay taxes on that money, and it can sit there and hopefully grow, and you can take it out the next year. Sorry, my phone's supposed to be on mute. Sorry about that. I thought my phone was muted. So they did change it. Now you're not required to take RMD until you turn 72, but they did they did make it so you don't have to take an RMD in 2020. So no required minimum distributions from IRAs. Now, charitable contributions is a big thing. A lot of people, especially used to itemized deductions. Now, I know a lot of my clients, especially small businesses, when they get to the individual level of their return, I take their K-1s from their small businesses, put them into their individual income tax return, they're not itemizing anymore. And a lot of them are very generous with their charitable contributions and things like that, but they've been getting no benefit for it because of the new standard deduction. The new standard deductions are over $12,000 for an individual, over $24,000 for married filing joint. So in some cases, for somebody who doesn't have a large mortgage, they're not getting any what they call tax benefit for their charitable contribution. There's always the intrinsic value of, I feel good for making the contribution, But some people say, well, what about a tax benefit? I've made all these contributions. Everybody, all the organizations put at their bottom of their receipts that this is a tax deductible contribution. Well, it qualifies as a deduction, but a lot of people are not eligible for those deductions now. So what they did in the last CARES Act is not a lot, but $300 of charitable contributions now are allowed to be listed above the line. So those are deducted straight from your income. You don't need to itemize to take that deduction if you make $300 of charitable contributions. So it's a nice benefit for those who don't itemize but give some money to charity. So they'll get, as I say, they'll feel they get something for their tax dollars. They get some tax benefit for giving to charity. Obviously, that's not the main purpose of giving to charity, giving to a nonprofit, but at least everybody, that's always been one of the nonprofit selling points is it's tax deductible. Well, yes, it's tax deductible, but a lot of clients, especially with the limitation on the state and local income taxes still at $10,000, are not getting any bang for their buck for their charitable contributions. They're still making them, but they're just not thrilled with them. They're not happy about it, the lack of the deduction. So one of the things that came in and to think about is that the AGI limitations for contributions is 100%. So if my adjusted gross income is $75,000 this year, I can make $75,000 of charitable contributions, and that those would be fully deductible. If I make more than that, I make more contributions than my income, well, that's fine too. I'm allowed to then carry those contributions forward and offset them against future years. But for this year, they did do away with the 50% and 60% cash contribution limits. So that's a big help. For corporations, charitable contributions have been limited to 10% of your taxable income, and that increased to 25% of your taxable income. So that's something to think about if you're making a contribution through a C corporation. If you're making it through a small business, generally those will, an LLC, an S corporation, or your sole proprietor, those will flow out and be put on the individual's return. For a small C corporation, they'll be able to take up to 25% of the taxable income, up to contributions up to 25% of taxable income instead of just 10%. Okay, PPP loans. I don't know who has them, who doesn't, but there are still uncertainties out there. I know a lot of banks right now are pushing you to start applying for forgiveness. They're pushing you to get that application in. What we're recommending, what the AICPA is recommending, is wait a little bit longer. We're waiting to get final legislation on this. Obviously, we have to wait for the election results, but there's uncertainties. Right now, if I received a $100,000 loan from the PPP loan, and I've used my funds appropriately, those proceeds are not, it's not taxable to me. So I get $100,000 of tax-free income, which is great. But then what they're looking for, the tax treatment of the expenses for the PPP loans, that's what everybody is waiting to find out about. The intent was that the expenses would be deductible. So the payroll that I've used paid with my PPP loan, the rent, the utilities, all of those things, the intent was for those to be deductible business expenses, which would then reduce your income just like they would do in any other year. The Internal Revenue Service's stance on that right now is that those are not deductible expenses. So any of the expenses that you paid with a PPP loan are not deductible according to the IRS. So we're waiting for legislation to change that, to correct that oversight. The feeling was, if the loan itself is not taxable, why not make the expenses related to it? Because otherwise it's negating the effect. So we're really hoping that we get guidance and that the IRS changes their standing, or Congress passes some legislation to change that. That's what we've all been waiting for. If you have rent payments to a related party, you need to think about related party rules, and we can discuss those if people have questions. But the amount of loan forgiveness isn't any more than the mortgage interest owed on the property. So that's just something to think about while you're doing your loan application repayment. If you have rent that you're paying to a building that you own, only the portion that would be mortgage interest would be deductible. Not the entire loan, not the entire rent payment, but only the portion that would relate to the mortgage interest. And mortgage payments to a related party are not eligible for forgiveness. A lot of people are structured where they have two separate LLCs. They may have one LLC that owns their real estate and a separate LLC that does operations. So if you have that scenario, the mortgage payments, if you're paying taxes to if you're paying a mortgage or rent payment to yourself, or paying mortgage, or you're holding your own mortgage, those payments are not eligible for forgiveness. So a lot of these things, Maryland does not always follow the federal government in their rules. This is called decoupling, and Maryland has done that a lot for a lot of different scenarios. So for the things we talked about earlier, for the interest expense deduction, for the limitation, 2018 and 19, Maryland is following the IRS. But for 2020, there's going to be a limit on interest expense. For the business loss deduction, 18 and 19, the IRS, if you're going back to amend 18, and if you did 19, it should have been limited unless you filed the return really early. So go back and look at that. But if there was a business loss limitation, Maryland is following the IRS for 18 and 19, but for 2020, there's an add back modification. So if you have a loss that exceeds these amounts, Maryland is not letting you take that entire loss. They're following this $250,000 and $500,000 adjustment. So that will need to be looked at. It's just something to think about when you're doing your tax planning. Don't just think about federal planning and saying, okay, my net income's whatever it is, and I'll pay taxes on this. Maryland will have some differences. So you want to think about what those differences are. And again, in 18 and 19, Maryland is following the federal government, so you can carry back the NOLs. Any net operating loss that you have from 18 and 19, those can be carried back for 5 years. In 2020, Maryland is saying, no, those NOLs can be only carried forward, and then only 80% of that NOL can be used to offset income going forward. So it's just some differences you want to think about. You're not necessarily generating losses in Maryland at the same rate you're generating them for the federal tax return. This is a new piece of legislation that came through July 2020. And it has some benefits, but you really want to talk about this with your tax advisor. So if you're an S corporation or an LLC and you have non-resident members or shareholders, you've had to pay to Maryland a portion of the taxes, prepay their taxes essentially with estimated tax vouchers. What this act did, and this is basically it's a way to get around what we call the SALT limitation of $10,000. Since we can't take the itemized deduction on those taxes, Maryland's made an adjustment here. That pass-through entities may be taxed at the entity level. So my ABC corporation will be paying my Maryland taxes, and I'll get a tax deduction on my federal return. I'll get a tax deduction on my federal business return. I won't get it on Maryland, but I will get it on federal, and then I'll take a credit for those taxes paid. I don't know if that makes sense, and if anybody has questions, once I stop speaking, I'll be glad to try to explain it better. But the taxes paid would be deductible as a business expense by the entity, and then individual and corporate pass-through entity members would receive a credit for those taxes paid. So if you have a business that's making $500,000 of income, Maryland, your tax is going to be figure 8% of that, 8.25 in some counties. You're not going to get that back in taxes. You're not allowed to take an itemized deduction greater than $10,000. But this way, you get a business expense deduction for that complete tax payment. And then you'll get a credit for those taxes paid on your individual return. So this is a workaround, but this is something you really want to discuss with your tax advisor before you make this decision. Some people are worried that Congress may come back and say, no, this is a workaround, we're not going to allow it. There are states out there that have been doing this for several years and they have not had any issues, but this is a position that you want to discuss with your tax advisor prior to taking it. Make sure that you have everything all squared away. Oh, Lisa just popped up there. I see your video. Hi, Lisa.
Hi, I have a question.
Sure.
So what impact does this have on the federal return, if any at all? Doesn't sound like any, but
Oh, no, it does. It's nice. So
okay.
you have your businesses and they qualify, make their Maryland tax payments for resident shareholders or members. So say it was just, I have $100,000 of income on that would be taxable to Maryland, and I'm going to pay 8% on that. So I would make an $8,000 tax payment to the state of Maryland. That's now an $8,000 tax deduction on my federal income tax return.
Oh, so it's going to go straight to the bottom line.
Right, it hits straight to the bottom line. So on the federal level, I pay taxes on $92,000 of income rather than $100,000.
So this is an election that you're making?
Yes, it's an annual election that would be made on a Form 510
Okay,
and a 510D when you make the estimated tax payment.
awesome. Thank you.
So this is something, it's new. There was a seminar debate, there was a meeting yesterday, you know, ask the legislator, and they hadn't really thought out all the answers to this. They said they just passed it really quickly without thinking of all the tax ramification, but it's in there and it's good to go. If you want more details, if you're a tax geek like me, they talk about it more in the Maryland Administrative Release number 6, which you can pull off the comptroller's website. I know everybody knows their administrative release numbers, but it's administrative release number 6, has a lot more details and gives you examples as well.
Hey, Cheryl,
Yes.
we had another question in the chat here, and this was, does the depreciation rule count for home office?
Yes. So your home office, if it's qualified business renovations that you've put into service in 2018, 19, or 20, you can't change your depreciable life from your home office from 39 years if you've been using it previously. So you need to look about what assets you're changing your qualified improvements on.
So while we're there, can I ask another question?
Sure, let's go for it.
So, you know, a lot of companies, practically everybody, really, business owners switch from on location to in-home office, you know, home office. What recommendations, you know, to the extent that you can provide any, should we be thinking about as it relates to the home office expense that we wouldn't necessarily have taken prior to March of 2020? So we still have lease office space that we're really not using. And then we also have home office expense now.
So unfortunately in 2017, Congress got rid of the employee home business use of office deduction. That's just gone. But if you're a sole proprietor working at home, you're not going into your office, you can't go into your office, and you have a dedicated workspace used 100% for business, then you could take the business use of home deduction, Form 8829, and reduce your income by that. That will flow to your Schedule C. The other thing is make sure that your clients are looking at the expenses relating to it and categorizing them correctly. Because my last slide, and this just came through, is the layoff aversion fund that Governor Hogan, they added more funds into on October 28th. And this is a great one. It's a grant for up to $50,000. And it's designed for small businesses undergoing economic stress from the pandemic to help pay for the cost of purchasing remote access equipment, the cost of covering software for their employees to work remotely. So there's a grant out there that they just refunded, put more money into. Refunded sounds like they took the money back, but they just added funds to that grant pot so more people can get this $50,000 grant, which is a great opportunity. The second I saw it, I called some of my clients. The second I read about it, I was on the phone with some of my clients because I have some restaurant clients, and there's a portion of it that can be used to cover, excuse me, paying for the liability insurance for restaurants that convert from sit down to delivery, because there's more of a liability if they have their own drivers out there delivering food, if they're not using Uber Eats or any of the other Postmates or any of the other services. So they've adjusted this fund to cover liability insurance, cost of covering sanitizing supplies, so you can doing deep cleans, so you can have employees in the office, software programs, and to any other professional opportunity developments to help your employees avoid a layoff. If you retrain them so they can do something from home rather than being in the office, the professional development costs for doing that, the classes, those are expenses that can be covered by this grant. So I think that's a really big one. Its idea obviously is to prevent layoffs. So this is a great opportunity that Governor Hogan just put in. It was originally, they started it previously, it ran out of funds, and in end of October, they just added more. So I'm really recommending to my clients that qualify for it, which most do, that they jump on it quickly if they haven't taken this grant before.
So going back to the home office question, you said as an employee, so it's only applicable to Schedule C filers, not to 1120S tax
Well, if
filers.
they're going to the office, you'd have to run it through the business use of office, and I can double check and email you if you give,
Okay.
Leonardo can give me your information. I'll be glad to look. I want to make sure I give you the right answer, not the quick answer.
Right. Okay.
Everything
Awesome.
changing, I want to give you the right answer.
Thank you.
Does anybody else have questions? I know I'm running up on time because I'm at 6 minutes. These were all the slides I had prepared, but I didn't know if there'd be other questions if I hit on a topic that people were interested in. But I really am thrilled about the layoff aversion fund. I think that's something great that Maryland did. And you can find that application link on the Department of Labor Licensing and Regulations website. And it'll go into all of this information I have on my slide. But I think it's just a great opportunity for small businesses to get additional funds to help them succeed and continue to operate.
Hi, this is Lindsay. I have a quick question.
Sure.
Back to the self-employment tax slide. I know that was like one of the earlier slides.
That's okay.
Can you just show that slide again?
Of course.
I just wanted to see that. Thank you.
And I'll be glad to give Leonardo the slide deck.
Okay, great.
This one. More.
Yes, okay. Oh,
I can't see which.
there we go. Yep. Okay.
And it's nice to be able to defer it.
Mm-hmm.
One other payroll option, which was for the employees, where employers did have the option of not deducting their payroll, the Social Security from employees, so they can get a larger paycheck,
Mm-hmm.
and then that has to be repaid. I have recommended to all of my clients, I know this sounds awful, not to do that, because they haven't given enough regulations and told us what happens if the employee switches jobs. Am I on the hook for the taxes that the employee should have been paid? So I've deferred my employees' taxes up through December 31st, 2020, and they started to repay them, and then in February, they get another job offer. Who's on the hook for those taxes? They haven't answered that question for us. So will they have to inform their new employer about this? And then how do we know it's done? So there's just too many questions in our mind to do that. We just weren't comfortable telling our employees that, our clients, that, oh yes, please do this, it's a great idea. Yes, it's a great idea, but we didn't have the rules in place to know what happens if an employee switches jobs. Now, there is some talk about this amount being forgiven, but again, nothing was passed, and I can only give advice on the current tax law as it's written, not what's proposed, because we never know what's going to get passed.
Got it. Thank you.
You're welcome. Sorry, any other questions? I hope what I've presented has been informative and covered some topics that you guys have found of interest. Leonardo has my contact information, as does everybody at the chamber. If you have any questions, please get in touch with me. I'd be glad to help you. But please, you can take this information back to your tax advisors, if you have them, and discuss anything with them. They may have a different perspective, but at least you can have the opportunity to discuss it and see if any of these can work for you for tax savings going forward.
Thank you so much, Cheryl. Leonardo had to hop off as he's got three kids at home, and so he's got to switch off to lunch duty.
I know the feeling.
Steal the share screen from you, and I'm going to show just a couple of upcoming events that we have. So if you visit the chamber website, obviously we just did the small business owners ask the experts, but next week we have our veterans executive speaker series. We have our GovConnect Scale Up webinar a little bit later in the week. But this has our full list of all of our events. We have our economic forecast breakfast that I think that he had kind of hinted at as well. One other one, if you're looking to do some in-person networking, this will be socially distanced. Masks will be required, but we're doing a lunch tailgate at Great Harvest Bread Company. So this is completely free to attend. We just ask that you pre-register in advance. So if you're looking to do a little in-person networking, this is a great way to get that in. But if you have any questions about any of the chamber events, feel free to reach out to any of us, and we'd be happy to get you going. And I think with that, I will go ahead and sign off. If anybody has any questions, again, you can reach out to us, reach out to Cheryl, or if you need her contact information, just let us know. Other than that, everybody have a great day.
Thank you.
Thanks so much.
Thank you.